I'm Imogen Ray Smith.
I'm David Bank.
I'm Brian Walsh, and this is Returns on Investment, a show about impact investing. On today's show, impact and ESG have gone mainstream. Now what? From BlackRock to Goldman Sachs to Bank of America to essentially every bank and asset manager, environmental, social, and governance factors are now the new thing. Epic sea change in finance, or fiddling while Australia burns? What really needs to change for the shift in investor sentiment to translate into a shift in global direction? Imogen, what's new in this recent round of announcements, and why now?
Those are both excellent questions, Brian. You know, we just had Davos. We've seen a series of announcements from major financial institutions, particularly relating to climate change and what they plan on doing. Larry Fink just did his annual letter, telling CEOs what he thinks. And so in some ways, there is nothing new about this, right? For the last 2 or 3 years, we've seen the same sort of drumbeat of ESG-friendly announcements, particularly from major organizations like, BlackRock, Goldman Sachs, Bank of America. And on the other hand, there does seem to be, and I think genuinely is, something new and different that is taking place. I think, for example, that some of these announcements, I tend to be very cynical and grumpy about these announcements. Again, you have a lot of institutions that, say on the one hand, look at all these amazing green things we're doing, whilst, for example, continuing to finance fossil fuel initiatives. But I do think that there is more teeth to some of what they're saying. There's more reason for optimism. For example, I think the Goldman Sachs coming out and saying that it won't take companies public if they don't have at least one woman on the board is important. There's a lot of caveats to that. They're really only talking about, North America and Europe. But I think that when we think about diversity and those issues, particularly as they relate to tech and Silicon Valley, that's a big deal. So I think you're seeing announcements that are more meaningful, and also this recognition by pretty much every asset manager, more or less every bank out there, that ESG is important. It's something that's central to what they do. And they have to figure out how to talk about it and how to do it well and how to put resources behind it. I think the issue is that two of the main issues are, one, they know ESG is important. They have no clue how to do it well. And I think that there's still a lot of questions around how to do ESG investment successfully that they're only starting to nibble around the edges of. And then are they really putting the commitment and resources behind this? And are they, what they're not willing to do is change the way they do the rest of their business, right? The broader, deeper issues that we're talking about here, climate change, social inequality, these are things that have been created and driven over the past, what do you want to say? Like, basically, they've accelerated over the past 3 decades to the point where we are now. And many of the institutions that are now coming up and saying, yes, ESG is important, were instrumental in facilitating those issues. So for them to now turn around and be like, oh my God, social inequality, who knew? Well, we're all hanging out here in Davos, shipping champagne and flying in on our private jets. Like, that's part of the problem. And, I think the danger is that a lot of these individuals and organizations want to have their cake and eat it. And rather than recognize the need for true transformation.
So, David, it sounds like Imogen is saying that there is this recognition that change is clearly necessary and that finance and the capital markets have a role to play, and that there's that kind of groundswell of understanding of that. But perhaps the companies and the investors that are stepping into the breach aren't doing much beyond tinkering around the edges of the status quo. What's your take?
Well, Brian, there's 2 main buckets of reasons that these asset managers give for adopting these ESG or impact strategies. One, and this is by far the largest one, is client demand. The second one is, actual fundamental, material things going on in the world, whether that's, all the evidence of climate change, or as Imogen says, people in the streets around social inequality or other things. And so those, sort of macro trends that they see going forward But mostly they're being driven by what their clients are telling them. And these are not just retail clients in your 401k. These are also big, major institutional investors who are saying, we want you to manage our money in a way that takes into account, the risks that we're facing, and that also, our stakeholders and all that stuff. So basically, they're under pressure. This is more a signal. These announcements I see as more a signal of the pressure they face than of their any kind of virtue that they've or even epiphany or moral conscience that they may have developed recently after, as Imogen said, several or many decades of extractive and exploitive practices. So, but it is interesting as a signal of that pressure. So there are changes going on in the way that the owners of capital want to see their capital managed, and so I don't think that the numbers being thrown around are very impressive. Even the $750 billion that Goldman Sachs pledged to invest over 10 years to a certain set of sustainable investments, that's effectively $75 billion a year. There's something like a $2.5 trillion gap in financing the sustainable development goals. B of A's commitment was, I think, $300 billion over 10 years. So these are not making big dents in the actual financing needed. So at that level, they are tinkering around the edges. The ESG measurements are basically help investors find the least worst companies, avoid the biggest, risks. They don't essentially drive new capital or new resources to the solutions. So I would say that there's a whole large step beyond all of this yet to go. On the other hand, I do think that putting some of these mechanisms in place, measurements, analytics, whatnot, is a building block. As we've said many times on this, on the show, it's all necessary. Is it fast enough? Is the real question.
And so, change comes about. There's an old saying that change comes about when people either see the light or they feel the heat. And so, Imogen, do you think that these announcements and these different changes and different initiatives from the mainstream capital markets, is this about them seeing the light or feeling the heat?
I think the number that matters here, the number that people that finance is paying attention to, is the fact that there was $20.6 billion of inflows into ESG ETFs in 2019, right? Like, that is a huge wake-up call to the industry. One of the reasons that the industry hadn't really moved before is because they didn't think there was money to be made in this wishy-washy thing called ESG. And all of a sudden, capital's flowing into it. I mean, there was like the majority of time before 2015, there was less than $5 billion a year of inflows into ESG ETFs, right? So the fact that there is money to be made, the fact that there is investment happening in this space, that is a huge deal for the financial services industry. And that's what turns the wheels of business for them. So that is both a carrot and a stick, right? We need to make money. This is somewhere to make money. Let's go and find the gold in those hills. Also, some of that money, some of that capital is going to flow into places that are needed for impact. I mean, in a sense, David, what you're doing is making the distinction between ESG and impact. And I do agree with you on many levels. And ESG is more of a risk mitigant, do no harm, than it necessarily is a, find the positives. But when we're talking about, stuff like green bonds and other, carbon credits, there is a bunch of investing that's starting to happen from the sort of mainstream ESG community that is forcing capital to be allocated towards the things that we all agree it needs to go towards, sort of, sustainable development goals, more impactful initiatives. So to this question of, is it just tinkering around the edges, something that is exciting here, and I think is a big change, is that you are starting to see ESG and impact and the questions that sort of this movement asks really penetrate the plumbing of capital markets. So again, historically, I think one of the big issues has been that it has not done that. There'll be some, like, social impact bond that was really expensive and like is very small, and that it's only targeted to a very small group of investors. Now you're starting to see, real questions about how is money market funds that actually, have ESG values. You're starting to see it really be a part of what businesses do, what finance does, and I think that's going to be an important shift.
I think there's another aspect to that, and actually I agree with you yet again, Imogen, because one of the, ESG essentially, impact, this is not hard and fast, but impact generally had been in private markets where it was seen that impact investors could have some, additionality or additional impact in backing ventures and whatnot. And ESG, as you said, has generally been seen as a public equities market kind of analysis, and helped you identify companies that did well on their environmental performance and that had decent working conditions. That was the S part generally. And then G was governance, as you said, when, diversity on boards and other kinds of factors. But that was mainly seen as public equities. And so the question had always been, where can you find any impact in public equities markets? They're so large and liquid, and any given investor doesn't really have that much say, and they're just going to kind of do what they do, and therefore not really that interesting from an impact point of view. Had been, I think, for most of the time I've been covering this field, the sort of general conventional wisdom. Now I think that's changed, and as you said, the actual positive impact of companies is starting to be valued, because that positive impact means they are identifying growth markets of the future that are going to become the revenue and profit centers, as you said, of the next period. And so, we've been trying to find these companies where it's not just that they, use a little bit less energy or have a little bit less waste or have a little bit better, benefits or whatnot, all of which is good, but that companies that actually their entire mission, their entire purpose is dedicated to, say, helping farmers, weather climate change, or helping big entities, universities or airports or college campuses, hospitals, radically, get off the grid, go net zero, this year. Those kinds of things where their business is actually, directly related to any, something we would all agree was impact. And those companies are starting to find that they are getting valued for that, because those are the growth markets of the future. So when that mechanism kicks in, I do think we might have a drivetrain to changing the actual world.
So is that a matter of companies and investors responding to market incentives, so that they are kind of feeling the heat of market incentives, and so they are rationally responding to those incentives, as opposed to seeing the light and kind of on their own volition coming to understand that?
Well, there's a middle ground. There's a middle ground.
Which is what?
Which is anticipating what they think might be the public, mandate, the policy mandate, or the market pressure, and trying to be in the front of that line as opposed to the back of that line, and there's some advantage to being the front of that line in terms of, in the classic case, writing down some stranded fossil fuel assets, or capturing this ESG fund inflow, as Imogen said, which was truly remarkable. So a lot of folks in the asset management and investment world have been saying in just the last couple months that something really did change in their shops in the last 3-4 months, and that all of a sudden, strategies that had sat on the shelf, memos they had written, initiatives, all of a sudden they're getting like, hey, let's do that now. Let's announce that now. We got to get this out the door. So all of a sudden, there's a big, I think, hiring frenzy going on. There's just a bunch of activity going on in all these to get ahead of this thing that they know is coming. So I don't think that it's yet been a firm policy mandate, but there's some kind of feeling that policy mandate's coming, that customer demand is coming, we better be ready for it, and that creates its own kind of race and competition. So we've been saying that sustainability is the disruptive force in asset management, just like technology was a disruptive force 20 years ago. Now sustainability is a disruptive force, and when you see the disruptive force coming, you scramble.
And how will we know whether this is the new normal or this is a passing fad?
It's all about your timeline, right? Like, if a year from now everyone is talking about, I don't know, disruptive technologies, then this was a passing fad. But this has already been going on a low level for the past decade, right? We're building on that work, and it's gonna, it's going to ebb and flow, but the basics are there. That doesn't mean it's going to be implemented well, right? I think, maybe this is, the end of the beginning, but there's an incredibly long way to go. And it's, the danger is everyone implements it badly, right? The danger is that it's a box ticking exercise. Everybody just goes and gets shitty MSCI data, plugs it in and calls it a day. And that this doesn't truly become integrated with finance and investing and the mechanisms of capital markets. If that's all that happens, then it's really just business as normal, and this is just sort of another department. It's effectively an extension of marketing and communications. The hope is that what we're seeing is really a fundamental shift in how we think about capital and capitalism. And then we've kind of moved from, if you had to sort of, the business of companies is to make money for its shareholders era, then you had the sort of, the Wall Street greed is good era. In a sense, it seems like what's happened is there has been this post-2008 reckoning that finance was destructive, and that maybe instead of just thinking about, how much money prop traders should make for themselves, we should start thinking about like how we can use these tools to both profit and benefit sort of the society long term and the sustainable economy, right? And so if that shift is really happening, then that's exciting. If all we're doing is just window dressing for like, a handful of billionaires to get a little more rich, then it's just really scary and depressing, and societal problems are going to get worse.
I think what you're asking, Brian, is the proverbial tipping point question, right? Which is how does it actually, move from, whether it's genuine or not, we're in some kind of, balancing act right now, and which way does it go, kind of thing, and the question is, how does it go in the direction where the sustainable and inclusive future is everything points to that, where it's not some rearguard battle to eke out these small gains. And I think the way that happens, and it's kind of interesting, is say you've made some bets on this new value proposition that we're just describing, right? Then you're actually incentivized to make those bets pay off. So you actually become kind of a lobby, or a kind of an interest group, so to speak. So, we've sometimes joked about like the sustainable industrial complex, right? Like there's starting to be a group of investors and certainly companies, but also investors and others that say, hey, I've made a bet that on the low carbon future, and it's going to pay off only if we really get to the low carbon future, because then my, low carbon technology is going to be really in demand or something, right? So I want to then drive everybody to the low carbon future because that's good for my business. I'm now a lobbyist for that low carbon future. And I think what we're getting to is a reasonable, I wouldn't say it's the majority in any way, but it's at least a, sort of reasonable minority of investors who are now have considerable stakes on that side of the ledger. So I think there's a constituency of capital. There's certainly a popular constituency, and that plays some role in it too. People in the streets, I think, are actually very important right now. But take those two things together, top down, bottom up, and a new kind of pressure politics around this kind of more sustainable future, because it will make these bets pay off.
in the classic technology adoption curve, right, you have the innovators, and then the early adopters, and then the early majority, the late majority, and then the laggards, right? That's the classic technology adoption life cycle or adoption curve. And there's this concept of the chasm, where you have to cross the chasm from the innovators into the early adopters. And it sounds like from what you both are saying is that we are at the somewhere in the early majority, right? That we might be at the beginning of the early majority or the end of the early majority when it comes to impact and ESG and getting towards the late majority, right? Is that, let me just stop right there. Is that fair that you think we're somewhere in the early majority? And if so, where are we in that?
Well, are you talking capital allocation, or are you talking sort of popular sentiment, or, what early majority of what?
Let's say adoption of the practice of incorporating impact and ESG analytics into investment decisions.
Yeah, I don't know that it's an adoption curve as much as a sort of more of an innovator's dilemma. Actually, hat tip to the late great Clay Christensen, who just passed away, and how markets tip. And I think there's a lot of evidence that in a whole variety of markets, we're now reaching the point at which the previously sort of irrelevant fringe innovation, whether that's a financial innovation or literally a tech innovation or even a social innovation, but that those things are now reaching the point where they become the new growth story in that market and eventually become the new majority. So it's I guess maybe it's an adoption curve, but it's also kind of this tipping point idea, and I think we're starting to see those now.
I agree with David. I think that keep going long enough, right? I think that we're clearly at the middle to late adoption phase. If you're just asking the simple questions of managers using ESG analytics, right? You now, particularly if you want to market to institutions in Europe, if you're a equity, private equity, maybe fixed income manager, you pretty much have to be at least talking about the idea of using ESG data.
I think you're totally right about that, Image, and I hear that that it's gone from the impact funds or the private equity, the real assets folks, proposing sustainability to the investors demanding that they have a very rigorous measurement system and the whole thing, and they're now on the other end of that.
Yeah, it's almost it's in Europe. It seems like table stakes right now.
But as I say, that is not the same as actually being a smart ESG investor, right? So, and I think the danger is that we're very much in a box ticking time, and that it's just proving, you wheel out the ESG person, they say whatever, and then you've ticked that box. I like David's analysis of sort of the tipping point. I don't think we're there yet, and I think that what you really need to see is, I know the Tom Steyers, the Larry Finks, the CalPERS of this world. Yes, putting real capital behind particularly renewables and clean energy initiatives, so that momentum starts to really accelerate. And I don't, there's still a lot of skepticism about that. I'm not sure we're there yet, and the struggle is still that there's a lot of money to be made in fossil fuel and related assets. So I don't think that tipping point has come, but I think some kind of mainstreaming has happened that can help move that process along. Will it do so quickly enough? We still need those bold leaders to stand up and say, yes, this is what I'm going to do. And I don't, it sort of feels like the herd has moved in an important way, but that acceleration has yet to happen.
I think to your earlier question, Brian, about how will we know? I mean, we're still seeing carbon levels rise. I think we're still seeing income inequality rise. So I think we need to start seeing actual, material change in direction at the real world level, and then we'll know that this atmospherics at the announcement level, actually is translating into something.
When you see companies like saying no to businesses that are still profitable, right? Like, it's one thing to say, oh, I'm not going to finance any coal assets any longer, right? It's another thing to say, I'm going to turn down doing business in Saudi Arabia because of its record on human rights and its treatment of women, right? Like, that's not happening yet.
Careful, Imogen, or you'll get your phone hacked.
Back to this idea of the adoption curve and thinking of this as a technology, right? Because the classic adoption curve is in crossing the chasm, and that whole notion is this nice, beautiful curve, and it's talking about how technology spreads. And thinking about impact investing and ESG analytics as a technology. And what does that mean to say that this is a technology that is spreading? Not saying that the amount of assets under management has gotten to the early majority or late majority. I don't think we're there yet, and certainly not getting to a place where the state of the world and the amount of carbon in the atmosphere and the amount of inequality in our society is getting to a place where you can see the real movement on that. But getting to the adoption of this approach, that would be I think an early indicator that we would be making ultimate progress on things like climate and things like inequality. So this notion of ESG and impact investing as a technology, I think that it is past the early adopters, and it is somewhere in the early majority. And it's interesting to see. It has become not a passing fad, but something that has gained a lot of momentum within mainstream companies, mainstream asset managers, mainstream banks, in the mainstream capital markets, that this technology is necessary, and people are staffing up, David, as you pointed out, and people are trying to demonstrate that they have this capacity. And as we've noted that in Europe, it's kind of table stakes to be able to say that you incorporate ESG analytics into your investment decision making. It's in parts of Asia, especially Japan, it's growing in importance. I think the U.S. as a whole is slightly behind Europe, but that's just not my opinion. That's my observation of the state of the market right now. But as a technology adoption, what does that mean?
I think you're exactly right, Brian. And there is a technology to it. I mean, it's essentially, there's a sort of algorithm that crunches through, data previously, primarily financial data, now including, these other, so-called non-financial factors like environmental, social, and governance factors, and that those factors have now been added to this, this great, data crunching optimization machine that spits out investment decision making. So it is being included. There's a lot of detail and methodology to be worked out, but as people start competing on that basis, as we've been saying, then that creates its own momentum for solving these methodology problems, and people actually compete on that as well. And you're seeing a lot of consolidation and investment in the analytics companies and the data providers and that sort of thing. So I think that's just to the same point that a constituency now exists, and that constituency wants to reproduce itself and expand, and so that's that's all to the good.
But I think the problem is that we're not seeing enough innovation around the data, actually. And I think that my concern is that I think that thinking about this as a technology is useful up until a point, but it's also dangerous, because I think that there is a lack of innovation in terms of like really consuming and understanding, and more importantly, paying for data. Like, I don't see the consolidation of the ESG data companies as necessarily being a good. I think what it means is you're seeing a race to the bottom in terms of how much people are willing to pay for this information, and that what investors have not yet figured out is what is good, high quality information that is going to drive good, high quality investment decisions. I think right now this is an idea that has taken root. I don't think it's a technology that has taken root. And I think that the danger is that it is just marketing, and that it doesn't sort of become embedded, truly deeply embedded in what finance is and how it operates.
All right. Well, with that, I think appropriate dose of pessimism, or let's call it pragmatism, into the conversation. I think that's a good place to wrap it up. Thank you, Imogen, and thank you, David.
Thank you both.
Thank you both.
Special thanks, as always, to our technical producer, Isaac Silk. Thank you, Isaac. This podcast has been a production of Impact Alpha, providing news and insights for those working to build an inclusive and prosperous future. Find us at ImpactAlpha.com and on Twitter at ImpactAlpha. From New York, I'm Brian Walsh, head of Impact at the fintech company Liquidnet. Thank you so much for listening. We'll see you in some sense of the word next time.